Okay, now on to our next speaker, FEC board member Jake Bernstein, who will be speaking about interest rates, currency, long-term cycles, and truly much more. You already heard him share a few highlights yesterday. I recall Japanese yen and palladium and other key nuggets that he'll be mentioning. As a brief intro, before he kicks off, Jake Bernstein has been publishing Jake Bernstein Weekly Futures Trading Letter since 1972 and trading futures and stocks since 1968. His forecasts and opinions are quoted regularly in the financial press and on financial websites, including Wall Street Week, CNBC, JAG FN TV, and webtv.com. Bernstein is a consultant for investors, traders, industry, financial institutions, brokerage firms, and commercial firms. Traders, money managers, and hedgers, both new and experienced, subscribe to his market advisory service. Jake, welcome. Wonderful to share your insights. Second time around for the year. So much has changed year to date. Please share your slide deck and lead the way.
Thank you very much. I appreciate the opportunity to present for the foundation. Very important part of my trading career has been the foundation, because that's how I originally found cycles, and that's the basis of my work. So without further ado, I'll begin now. We're talking today specifically about long-term cycles and interest rates, currencies, and small trader sentiment. And first, a little bit of an introduction, the usual disclaimer. So you should now be seeing slide number 2. Any moment now, here you go. And so you've probably seen this at least 100 times, so it hasn't changed since then. It's the same. You can lose money trading. And what I'm presenting here today is strictly for educational purposes and evaluation of what I'm doing in the way of the markets. I want to thank the Mount Foundation for the outstanding support, especially the FSC staff, members, and the board, and kudos on a great round of presentations here. So today I am in a place called Bonnie Doon, California, which is on the California coast. I'm deep inside the redwood forest, right over here, about 1,500 feet above the Pacific Ocean. Nice and quiet, good place to be generally off the grid, and we enjoy it very much. So today, just generally speaking, a little bit of an introduction of who I am. I've been a trader since 1967. I've authored over 43 books on trading by major publishers. I'm a real trader, which means specifically I really trade, and I do so practically every day. I am not primarily a day trader, although I am a short-term trader. Everything I do is purely technical, no fundamentals whatsoever. My work is computer-based, it's tested, and is developed in all of my strategies. And so in my work in the markets, I've taught thousands of traders all over the world. I've done about 883 seminars, webinars, and so forth. I'm a member of the Foundation for the Study of Cycles. I've been on Wall Street Week, CNN, FNN, CNBC, and so forth. And the good news is I'm not a broker, I'm simply a trader. So everything I do is 100% objective, completely rule-based, and I don't do any analysis. My clients, individual traders, top newsletter writers, and some of the biggest hedge funds in the world subscribe to my research. So let me give you an idea of what I do and hope that it can help you in your trading and investing. So I started trading in the summer of 1967, which is when I discovered cycles in the old Cycles magazine that was published many years ago. I was fascinated by what I saw and felt that I had finally reached the point in my career where I could depend on things in the market to be clear and consistent. I studied cycles intensively for a number of years before I started trading, and then began developing my own indicators. So what you're going to see here today is a very small portion of what I do, specifically based on repetitive patterns and cycles. The most important thing I can tell you about my work is this: everything I do is based on patterns. Patterns pervade everything we do, whether it's the cycle of life, birth, maturity, maturation, old age, and death, the cycles of the planets, the cycles of the weather, the cycles of patterns in the markets are all related. And in my view, if we find the right patterns and develop them properly, we have a lead on the market and what we can do. So my use of cycles is purely pragmatic, certainly interesting from the standpoint of science and philosophy, but I don't get involved in that too much. I'll leave that to other people. My applications are strictly for the purpose of investing and trading, making money, and then, of course, the development of patterns that will help humankind in general. So we're going to look at some examples of patterns and the trading model that I use. So the first thing that I do is use a trading model, which is very specific. It consists of 4 parts: setup, trigger, follow through, and profit maximizing strategy. In other words, it's a specific approach to using patterns. But in order to use patterns, we have to find them first. And the fact of the matter is that using computers, we can find literally hundreds and thousands of patterns. That's the good news. The bad news is, excuse me, the bad news is that most patterns don't work. They don't test profitably. So if we ask the question, does this particular pattern go forward in real time and produce predictable results? The answer we find in most cases is no. Example: a very popular pattern among traders is what's called the key reversal, which I'm showing on the screen right now. It consists of a 2-day pattern: day number 1, day number 2. On day number 2, the algorithm is very simple. We trade below the low of day number 1, and we trade above the high of day number 1, and we close above the close of day number 1. So it's also called an outside reversal. In other words, we supposedly clean out the stops below the market, clean out the stops above the market, and then we're ready to go higher by closing higher on the day. This very popular pattern looks good on paper, looks good on the computer. There are literally thousands of them. That's the good news. The bad news is that in testing, we find that this pattern predicts nothing. It is very low probability of success in predicting future events. However, making a small change by adding one item to the algorithm, which is a higher close, the third bar, the third day, makes the pattern predictable. This pattern will go forward and predict 5, 10, 15 days out what's going to happen to the markets. So this is an example of a pattern in terms of what it does. Setup over here, trigger over here, and then of course comes the follow through. The follow through consisting of 2 parts, and that is the profit maximizing strategy and the stop loss. So in this case, the setup is here, the trigger is a timing indicator, and the follow through is a profit target and a profit maximizing strategy. Within the context of what I do, cycles are a pattern. They fall into this group right over here. So it's not sufficient for me to have a cycle or to know what that cycle is going to do and where it's going to go. But what's important to me is, will the pattern lend itself to being timed? In other words, when will the pattern bottom or top? And then will the pattern allow us to take a profit at some point? So if I say there's a 5.7-year cycle low to low in corn, that's wonderful. But what do I do 5.7 years from the last low? Today, I hope to show you some of the tools that I use in order to zero in and zoom in on that second trigger. So in the process of giving you my methodology and telling you what I think is going to happen based on the cycles, I'm also giving you an indication of how to do this on your own. So let's go forward to the next slide for a moment. And by the way, if you find that you're still lacking information or something is unclear, you're always welcome to write me. I'll give my email address at the end. So let's go to the next slide and give you an example of what I'm talking about. So my primary indicators are price cycles, cycles and indicators, divergence, seasonality, which is the cycle that occurs within the course of a year, the commitment of traders report, and indicator patterns. So these are my primary tools. Today, I will show price cycles, seasonals, and the commitment of traders report, how they work together in giving us important moves and predicting important moves. So let me show you specifically what I mean. I'm going to switch now to a chart of euro-dollar interest rate futures. Not to be confused with European currency. The euro-dollar is a short-term interest rate market. It measures European currency, it measures the American dollar in Europe. So it measures short-term interest rates in the 91 T-bill, similar to the 91 T-bill, but traded in European banks. So this is really an interest rate future. You can see from the chart it's been a fairly symmetrical cycle, not perfect, not a beautiful sine wave, but still, interestingly enough, approximately 1, 2, 3, 4, 5, or 6 years between lows to lows. Right now, the cycle is predicting a low approximately 6 months from now, sometime later this year. In addition to this chart, I've shown several things on the chart. The commitment of traders in green over here, and small traders sentiment at the bottom of the chart. The commitment of traders report is issued by the US government every week, and it shows the 3 major categories of traders: large traders, small traders, and commercials. I'm not interested in what large traders or small traders are doing. I'm interested in commercials. Commercials consist of the largest traders in the world, specifically banks, insurance companies, government funds, retirement funds, and so forth. And so what I want to know is, what is their position in the market? When their position shows green, it shows that they are net long the market. In other words, they hold more long contracts than short contracts. And you can see how they tend to build up their long positions at cyclical lows, as they did over here, and here, and here, and here, and here. They're not always right, but the vast majority of the time they are right. So in building up a net long position as they are right now, they're preparing for a cyclical low in interest rates to come in the middle or latter part of 2022. So it is, even though this is not a perfect cycle, it gives you an idea of how we find the big moves. In addition to that, looking at the bottom of the screen by the red arrow, we see small trader sentiment. In other words, the small trader who is most apt to lose their money trading is shown here by what we call the daily sentiment index. The daily sentiment index is compiled in my office and has been so since 1987 daily, and shows the consensus of opinion of small traders, in other words, inexperienced traders. And we find an interesting correlation. When the small trader is extremely negative, as they were here, and the large trader is buying at the cyclical low, that shows the most important, most predictable combination. So what do we have now? We have interest rates following their path to make lows later this year. We have small trader very negative, and we have the large trader buying. So this poses the perfect combination for a big bull market. Remember that interest rate futures are plotted the opposite way, namely, when futures are coming down, interest rates are going up. When futures are going up, interest rates are going down. So we can see that the current decline in interest rate futures is consistent with the current increase in interest rates in the United States and other parts of the world. A very important forecast, which is due to bottom in interest rates later this year, which many people are not expecting, because as you may know, they're talking about interest rate hikes to slow down a supposedly overheated economy. So we're going to go to another one momentarily and take a look at it. And remember, not all cycles are this beautiful or symmetrical, but this is certainly one of the best. And it makes me wonder why the government has to hire so many people to predict interest rates when it's so easily predictable with the cycles. Let's go to the next chart. Here we go. Consistent with the interest rate cycle in short-term rates, here is a cycle in long-term rates, the 30-year bond. As you can see from the cycle, it's not perfectly symmetrical, nor does it predict all the lows or all the highs, but you see, generally speaking, it's been very accurate and has been almost perfect for the last 3 cyclical repetitions. You can find many of these cycles using the cycles application at the Foundation website. So what's the prediction? The prediction is lower futures, generally higher interest rates until late 2022, at which point we expect a bottom. So within the context of my setup, trigger, and follow-through approach, this is a setup. A setup requires a trigger, which is what most people call a timing indicator. You will notice from the bottom of the screen that the small trader is negative, not extremely negative, which is what we would require for a bottom, but certainly on the negative side. At the same time, the large trader, commercial, has started to accumulate long positions in anticipation of a low later this year. Remember that the large trader is usually ahead of the game. They begin their buying program before the market's bottom, and once the market's bottom, they stop their buying and begin to sell. So that is the 30-year bond cycle, still moving lower, predicted the top very accurately, and suggesting higher interest rates for the rest of the year, but not necessarily extremely high, given the fact that the small trader is becoming very negative and beginning to buy the fact that we're getting higher interest rates. To be perfectly clear, the cycle continues to point lower, with the bottom due late this year. Moving to the 10-year Treasury note, a very predictable cycle as well. And this is a point of extreme interest to me. You will notice the ideal cyclical low on this shorter term rates is due right now. You can see a very big spike in commercial buying activity, also negative small trader sentiment. How do we put this together? It simply says short-term rates, the 10-year, will likely bottom before the 30-year does, which means there's an opportunity on the so-called yield curve, by which I mean long-term rates versus short-term rates. Again, you'll notice this cycle has been very regular, very predictable, not perfect, but certainly workable in terms of the trading standpoint, which is what my interest is. Note also, at this extreme high in interest rate futures was also an extreme high in small trader sentiment. So the small trader sentiment itself is a very good indicator and a very good pattern of lows and highs, which I will demonstrate clearly shortly. Let's go to the next slide. The next slide shows Swiss franc futures. And again, a very predictable cycle, not perfect, as you can see from the lows and the highs, and certainly past its low point. So this is an interesting cycle. What it says is the Swiss franc relative to the US dollar should have bottomed a few months ago. At this point in time, you can see strong commercial buying activity, which suggests to me that the Swiss franc has bottomed, or most likely bottomed relative to the US dollar, and may be one of the best currencies to own in the next few months. In other words, that the Swiss would appreciate against the US dollar. We shall see how that turns out. Similarly, the US dollar index would show an opposite sign, opposite signal. In other words, here's the short-term, the intermediate term cycle in the US dollar interest rate, in the US dollar futures, showing the dollar gaining and having scored a perfect low on the cycle right over here, over here, and over here for the last 3 or 4 cycles. So the cycle points higher, therefore no surprise that the dollar is moving higher against most currencies. And you can see the small period of commercial buying activity ahead of the bottom, which is made over here. So the US dollar, in terms of its cycle, is past the midpoint, suggesting we will top. Notice also the small trader is extremely bullish, the most bullish they've been since here. And you'll notice how the correlation looks. Bullish sentiments for the small trader right at the top, bearish sentiment at the bottom, bullish sentiment at the top, and now extremely bullish sentiment. In other words, meaning that the small investor believes the dollar is going to gain in strength against most foreign currencies. Usually the opposite will happen. Let's go to the next slide. And here's the slide for the European currency. Interestingly enough, the cycle is due to bottom right over here, and we are at the bottom of the cycle right now. You also notice at the same time, the small trader is very negative. So these two pieces of information are extremely important in predicting a low of significance. What's most interesting is this. Many traders are now beginning to believe that the dollar will continue strong, but the charts say no. The charts say that the dollar will top and that foreign currencies will bottom against the dollar. The one thing that's missing from this chart very clearly is commercial buying activity. We want to see the commercial come into the market on the long side. That has not happened yet. So the pieces of the puzzle are not in place, but we're waiting and we're looking at the charts daily to see how it turns out. But I would say it's a little bit late in the game to be short the European currency against the US dollar. There is considerable talk now that the dollar and the Swiss and the European currency are going to parity, namely that they will be equal. I don't believe that based on the charts. We shall see how that turns out. But remember, we're still waiting for the timing trigger. We have the setup over here. We have this setup over here, but we're still waiting for a trigger. That has not happened yet. Let's go on to the next chart. And sorry about the voice. It's allergy season here in California. I wish I could do better than that. Notice this. I've taken the same chart, the European currency chart, and added to it the cycle, but this time not in terms of price, but the cycle in terms of small trader sentiment. While it is not a perfect cycle, it does predict that the small trader should be at its most negative point right now, and that certainly has been the case. So these two go together very succinctly and tend to be very valuable in terms of predicting the direction of the markets. Let's go to the next slide now. And this slide shows, let me see what it shows. It's hidden. One moment, please. British pound. One of the most predictable cycles in all of the commodity and currency markets is the British pound. This bigger cycle in orange is 8.1 years from low to low, and the validity of this cycle dates back to the 1950s. It's been highly predictable, and within that 8.1 year cycle is a half cycle drawn in bluish green. What's happening right now? The British pound is on a declining cycle against the US dollar and is unlikely to move significantly higher for several more years, so the prediction is still bearish. Bearish the US dollar against the US dollar, which means you want to be long US dollar, short British pound. But you may do well to study this cycle. It's definitely beautiful. And one wonders why. Why it's so clear and why so predictable? 8.1 years. The next cycle is, let me go to the next page for a moment, please. Canadian dollar. You'll notice that the Canadian dollar cycle has been fairly predictable, not perfect, and is now due for a cyclical low late this year. I'm sorry, early this year or later this year. So I would be looking at the Canadian dollar as a bottom. You will also notice that at the top of the dollar, the small trader was extremely bullish right over here and is now becoming very negative on the dollar with a small amount of commercial buying activity, meaning that banks and financial institutions are beginning to buy the Canadian dollar against the US dollar. And commercials are net long this market, a very important feature that you will see repeatedly at cyclical lows. In other words, commercial buying, small traders selling, commercial buying, small traders selling, commercial buying, small traders selling over here. Let's go to the next chart. Moment, please. Here we go. Long-term cycle. And this is a long-term cycle in, one moment, please. The Japanese yen. This is one of my favorite cycles. I want you to see the beauty of this cycle. Not only is this 7-year cycle almost perfect in terms of predictability and in terms of regularity, in other words, symmetrically, but it also shows the great predictable relationship between small trader sentiment, tops and bottoms. As an example, the most recent cyclical low right over here, accompanied by massive bank buying, accompanied by huge small trader sentiment on the negative side. The lowest sentiment in the history of the Japanese yen was followed by a substantial move up against the dollar. Now on the chart, this may look small, but in terms of dollars, it's huge, because remember, the leverage in futures is about 98%. What's happening now? According to the chart, by the end of the year, and certainly now, the small trader is very negative. The major cyclical low is due, and the small trader is negative, with the large investor, the large speculator, buying large amounts of currency. So in terms of predictability, we're looking for the yen to bottom by late this year. Remember that even though cycles are very good looking in terms of reliability, they are not perfect, which means to me, the yen could bottom against the US dollar at any time now. Therefore, to pursue the short side would be, I believe, too foolhardy and too risky. It's in a beautiful cycle, and we can measure it. Let me show you. 1, 2, 3, 4, 5, 6, 7, 7.1 years on average, approximately 8 years. Go back and study this one. It's certainly worthwhile studying. Let's go on to the next one. Moment, please. Here we go. In addition to cycles and price, we look at seasonality. So the highest odd cycles occur within 6 significant periods of time during the year. And my goal is to know the complete cycle before it happens and take advantage of that. In order to do that, I do a search for seasonals. Example, if I search the database and ask the question, have there been any patterns in the Dow Jones since 1920 that have been highly predictable? Here is what I find. One moment, please. Here's what I find. I find that buying the Dow Jones or equivalent on the close of trading, October 26th, exiting close of trading January 12th, with a risk of 100%. Let's go to 15% risk over here. So it'll be October 26th to January 10th with 15% risk, has been correct 83% of the time. It's difficult to believe that since 1920, considering World War II, the Korean War, Desert Storm, the Gulf War, inflation, disinflation, the Great Depression, Democrats, Republicans, you name it, we have still seen huge consistency with 83% probability of being correct. In other words, what the chart says or what the table says is very simple. It says that 83% of the time, the closing price of the Dow Jones on January the 10th has been higher than it was on October the 26th, 83% of the time, without having gone against you by 15% or more. It's truly an amazing statistic because it tells us that there is regularity in the market and certainly cycles within the year, which we call seasonals. Let's go to the next slide. I can take the data and draw a graph. So if I take all of these stock index futures March contracts from 1987 to 2022 and draw one curve that has been detrended, this is what I get. The meaning of detrended is really simple. I've taken each year and made the low of the year equal to 0 and the high of the year equal to 100, giving me a pure and clean chart. Therefore, by knowing the percentage probabilities week by week, I can establish a trading pattern. I know, for example, that 80% of the time, the first week of December has been a bullish week. The second week of December has been a bullish week. In fact, there have been no predictably bearish weeks because most of them fall in the 50% range. This is the kind of information that I can use. I know, for example, that the month of February, the first 3 weeks have been very bullish, the arrows indicating statistically significant moves to the upside or conversely to the downside. Let me go to another chart. and show it to you. In order to do my search, well, we can forget about that. I can search shorter periods of time as well. So for example, if I go to the location for searching and I ask the computer, show me trades in S&P futures for the month of April, which have been correct 75% of the time, that have had a duration of less than or equal to 25 days, this is what I get. So let's take a look at it. Here's the data output. One moment, please. Buying June S&P futures, close of trading April 14th, exiting close of trading April 26th with a 3% stop has produced these results. Again, very important because most traders can't even achieve 50% regularity in terms of their predictable trades, but in terms of seasonality and cycles, these statistics are very high, and the best part is they can be tested so that we're not talking about opinions, we're talking about facts. This is a fact and not an opinion, and on the basis of facts, I can make money being pragmatic about cycles. Let's go to the next slide. If I wanted to look at all the data, every year, every statistic, every entry, every exit for this particular trade is shown on this table. I show that to you because in most cases, traders are not able to produce statistics to validate their claims. We can look at the performance like this. And again, I'm not suggesting to you a trade. I'm simply giving you an education and telling you if you would like to find trades that are highly effective, you will use seasonals and seasonal cycles, as well as long-term cycles, which will give you significantly bigger moves. If I take the S&P composite from 1984 to 2022 for the entire year, I can find the strongest periods of time. For example, October, November, December, very valuable information, not only for traders, but for investors as well. I can isolate specific weeks as well as the trend. This is the June trade, for example, right over here. This period of time, July, the first 2 weeks have been bullish weeks. This is how the trade turned out this week, this year, in June and July. In addition to that, we can use timing. So here is the timing indicator that I developed to take advantage of the cycles. Example, if we go back in time, you will remember I showed you the Japanese yen cycle. The Japanese yen cycle, as you will recall, points lower until the end of this year and has been persistently lower. By moving to a smaller time scale from a monthly pattern to a weekly pattern, we can develop timing triggers that take advantage of this move. So what the expectation was, namely that the yen would move lower against the dollar, has been borne out by the facts, and we've been able to take advantage of these facts by using timing triggers. So just in a few cases, let me show you a couple more. We showed the cycle in we didn't show the cycle in S&P, which has been bearish. We can take advantage of that cycle again by using shorter term timing indicators. I think I have a better one for you. Yes, the Treasury notes. You will recall I showed the Treasury note chart, the 10-year note indicating bearish activity at this time, at least until the middle of the year, bottoming right now. Taking advantage of that cycle by using shorter term timing. In other words, the indicator turns red indicating a sell, suggesting that the lower prices would be consistent with what we saw in the cycles. In addition to that, although I did not show the energy cycles pointed higher at this time of the year, and this is how we took advantage of those cycles with timing. And Bitcoin, of course, which we did not show cycles on, so I won't go into details on that. However, another market, copper. Copper has had one of the most predictable cycles in history, a long-term cycle, and the cycle bottomed right over here. And again, this combination, which I showed you before, cycle low, strong commercial buying, and small trader sentiment very negative. This is the ideal combination, the so-called perfect storm. It happened here, It happened here. Commercial buying activity, cyclical low, small trader negative. And over here, small trader negative, commercial buying activity, and cyclical low. Let's look at another one. Now here's one that's coming up, so pay attention, please. Although certainly not the most glamorous of markets to trade, cocoa has had a very predictable cycle. I'm showing the cycle on the chart. What is the combination we're looking for? Number one, we're looking for a projected cyclical low, which was due to occur late last year. At the same time, there was a small blip in commercial buying activity. And previous to that low, there was very negative small trader sentiment, which is becoming negative again. So even though the cycle has not bottomed on time, we remain in a time frame where the probability of a significant low in cocoa futures could occur at any time. So watch it closely. In a few months, we'll update this forecast and see how did we do. Notice what happened at the last cyclical low. Huge commercial buying activity, extremely negative small trader sentiment, perfect scenario at the cyclical low. And similarly here, small trader sentiment very low, commercial buying activity very high, and it'll do a cyclical low that was due. Let's go to another chart. Another indicator that we've developed is called contraction expansion. We notice that when a market is due to bottom, the cycle begins to narrow, volatility begins to decrease, and then once volatility increases, our indicator turns green, suggesting that a bottom has occurred. Let's go to the next one. Similar situation on the downside. As long as the indicator remains red, the market remains in negative territory. So in terms of the components, setup, trigger, and follow through, the cycle is a setup. This indicator is one of our triggers, and follow through consists of a profit target as well as a profit maximizing strategy. Let me show you a few more cycles. I think I gave you all the cycles. Yes, we looked at all the cycles. There are more cycles we can look at if we want to. Let me go back to full screen on this mode here. Just one moment, please. So in terms of the cycles, the important one is cocoa. Watch that closely. Another situation for which I don't have a chart right now is palladium. If you take the time to look at palladium, you will find very strong commercial buying. In fact, the strongest commercial buying in history. Very, very low small trader sentiment and a cyclical low. So palladium, even though it's a thinly traded market, has potential for significant movement to the upside based on the combination that I told you. So I'm basically done with my presentation. I hope you've learned something from it, and certainly I invite you to ask questions, and certainly I invite you to ask me questions by email. My email address is jake@trade-futures.com. Let me put it on the screen. There we go. So I can be reached in any of the following email addresses if you have questions for me. And certainly, Ron, if you have any questions, I'm happy to take them.
Thank you, Jake, for sharing the latest market insights with, as you mentioned, setup triggers and follow-throughs for everyone to reference and consider. Our top question actually on your original framework, Jake, so the setup, trigger, and follow-through, in the context of dollar yen and that big bottom, that 7-year cycle, how do traders avoid catching a falling knife?
It's a lot better to buy on the way up than it is to buy on the way down. So in terms of the timing methods that I've developed, which include the moving average channel and divergence, one of the best ways to spot a bottom and not catch the falling knife is to buy on strength, which most traders can't do because they're psychologically not able to. But divergence is probably the best indicator we have. And certainly if anyone wants information on that, they can send me an email. I will send them the 6 best timing triggers video, which explains how to use timing to avoid that falling knife catching syndrome.
Thanks very much. And then a follow-up question on gold. which you briefly featured. So big question in terms of what the hell's going on with the gold market, given that it's broken down lower, even though inflation is still strong, and there should have been so many reasons for it to hold up. There's a question from Steve. Jake, gold would seem to have extreme small investor sentiment and positive commercial activity. Do you agree? And what is your view on gold?
Beautiful question, man. The key to gold is this. We have been taught many years to believe that gold is a crisis investment, so that when there's international conflict, economic uncertainty, traders flock to gold. What's confusing most traders right now is the fact that it's not happening. The reason it's not happening is it's not time yet. If you look at the history of gold, the largest moves up have happened in August, September, and October. So the market is just waiting for an opportunity to bottom, and therefore it's best to stay aside at this point in time. And by the way, again, I apologize for the voice. I had a very bad case of COVID a few months ago, still recovering from it. So the bottom line is be patient with gold. I do not see any evidence of heavy commercial buying. I don't see sufficient evidence of small trader sentiment being too negative, but it's a question of time before the small trader throws in the towel, becomes very negative, and we are speeding toward that August, September seasonal low. Study the behavior of gold prices during August and September. You'll be quite impressed with what happens.
And as part of the framework that you shared with us, Jake, so seasonality was a key part of it, and it was really interesting chart you shared there. I believe it was from late October to early Jan, an 83% probability of the market being up. Is there any context as to why that pattern exists, and just the fact that it's just such a great probability?
I wish I had the answer to that question. It never ceases to amaze me how cycles have been able to predict what's happening in the future, despite of fundamentals, in spite of government, in spite of currency fluctuations, in spite of the international situation. I can only say that it's been a valid investment cycle because of business. In other words, traders tend to invest money toward the end of the year and tend to throw in the towel and take their profits at the beginning of the year. I suppose that if I was a good researcher, I could go through and study what was it about every one of those years during the month of October that made stocks a valid investment. But I don't have that opinion. I don't have that capability, nor do I have the time on my hands to do that, but somebody should.
Anecdotally, of course, the October fall crash season, where typically markets have elevated volatility, so that maybe that shakeout creates the vacuum for a bounce back thereafter. It's interesting to see just how strong those stats are.
That's true. And interestingly enough, Ron, you also have dates into December, as you can see over here. So the computer gives us all of the possibilities and puts the best one at the top of the list. So this is the best one right over here, the first two. But there's also dates scattered throughout this period of time from October until January of the next year.
Okay, and Jake, could you just add some more color to the stop percentage area? I find that quite interesting. So we can actually kind of draw down thresholds.
Yes.
So, and 15% was what you're alluding to.
Yes, the 15% stop means that from the 26th of October until the 11th of January, stocks have been higher and have not closed against you by more than 15%. So that's where the 15% stop comes in.
Very useful information. A follow-up point is on, well, the COT commercial is just a breakdown of what exactly that is, especially for those who are looking at it for the first time. So Jason's asking about whether it's dealers, asset managers, or leveraged buyers, or is it a combo of all?
It's a combination of several entities, several enterprises, large traders, by which I mean commercial large traders, banks, insurance companies, hedge funds, and corporations that need to hedge currency. So those would be commercials. In the grain markets, for example, a commercial would be a farmer, a commercial would be a grain elevator operator, a commercial would be a large end user. So these are primarily the individuals who need to hedge currencies or who need to buy, hedge, or sell hedge grains or metals.
And then flipping onto metals, there's a question from Mark about palladium, which seemed to be kind of a star trade setup. I know the chart wasn't on the screen here, but you did mention it. Question from Mark: what's the best way to play palladium beyond just buying futures?
There's PALL, the Palladium ETF. There's SPPP, which is the Palladium and Platinum ETF. Those are the two best ones that I'm aware of.
Okay, and then a follow-up on Bitcoin. It was mentioned, but I know it wasn't the key feature. Any insights you can share about Bitcoin?
The Bitcoin up until recently has been in a significant bear trend. Unfortunately, there are not sufficient longer-term cycles to make it a valid prediction, but the cycles tool, as shown by Lars very, very clearly at the foundation, has made some excellent predictions over the shorter term. And my work says that the Bitcoin will bottom at any point in the next several days to weeks. So we're looking for a low in Bitcoin.
Okay, and then a technical question on the volatility-based indicator. I think you described it as contraction expansion.
Yes.
How key is that in terms of your experience of using it for trade setups and any kind of additional information that you can share on that? Some of the delegates are keen to learn more about it, but also to know how to access it.
I've only recently developed this indicator, and I'm still learning how to use it. Initially, it's proving to be very effective. If anyone wants the code, I'm happy to share it with members, or anyone who wants the code, I'm happy to share it. I have the code available for Wealth Charts, Trade Navigator, Trade Station, and Thinkorswim, and I'm happy to provide it as part of what we do here.
Thank you, Jake. And just as a final wrap question, the audience heard you say previously the chart that made you the most money. Which one is that, and what was the story?
The story there was the chart of real estate activity of 17 and a third years, which I did not show here today, but I did show it in one of my annual forecasts that I made for the foundation. In fact, I think I showed it at the last annual forecast. It shows the 17 and a third year cycle in interest rate futures, in US real estate activity, which is topping between 2020 and 2022, which was the original forecast. The way it made me so much money was that I bought a lot of real estate at the bottom of the cycle, and that has done extremely well for me.
Thank you very much, Jake. Any final words you'd like to share with the audience and the foundation?
The foundation is a fantastic organization. It gave me my start. The research has been incredible. It has pervaded everything that I've done. So all the patterns that I use that are high probability are cycles and seasonals, and all of those thoughts and ideas came from the foundation. And I'm very much indebted to the foundation for this wonderful work they're doing. If someone is not a member, it's the cheapest thing that you can do with the best returns possible.
Thank you, Jake. Our FSC board member speaking about the value that we all want to bring to each of you around the world in terms of cycle application, general awareness, and ultimately actionable strategies.
Thank you.
Thank you very much. Thank you, Jake.
Pleasure. Take care, everyone.
And just as a brief preview for day 3, yes, we are still rolling with this exciting agenda. Day 3, following on presentations from guest speaker Peter Eliadis on her cycle theories projecting future prices and current US market, and then FSC board member Bill Sarubi, US stocks, real estate, and the economy. Look forward to seeing you all tomorrow. Thank you from me, Ron William, FSC Development Director. If you would like to follow up with us, please check the website. See you tomorrow. All the best.
Take care, everyone.